Hello friends, good evening to all of you, and now let's have a look at the components of the regulatory capital. I already told you we are having the capital tier 1 capital and tier 2 capital. Tier 1 capital is said to be the going concern capital. We say it to be the core capital, and it is having two components: common equity tier 1 capital and the additional tier 1 capital. Common equity tier 1 capital is said to be CET1, common equity tier 1 capital. Additional tier 1 capital is said to be AT1, right? Further, tier 2 capital is said to be the gone concern capital. Also, it is said to be the supplementary capital. It is also said to be the supplementary capital. Now, there is a very good philosophy in general also, that in good times, if you save money, then it is going to help you in the bad times. Same is the case with the Basel III guidelines. So there is a conservation buffer, and we say it to be capital conservation buffer, and that is CCB. CCB, right? So capital conservation buffer states that the banks are to maintain 2.5% of the extra capital in their good times that can absorb much more losses in the bad times, right? So that is a CCB, that is a surplus capital which is to be maintained, and it is mandatory. It is mandatory. Previously, it was the case that the banks were to maintain this CCB 2.5% in 4 different tranches of 0.625%. But now it is mandatory for the banks to maintain 2.5% of the capital. Is that clear? Right? Now, let's have a look at the table here. So I told you already that the BCBS says that the minimum these much guidelines are to be maintained, but the regulators may ask their country banks so as to maintain the stringent guidelines also, right? So that's also the case in India, that in general the guideline related to CET1, that is a minimum common equity tier 1 capital, that is to be maintained as per the BCBS, that is Basel Committee on Banking Supervision. It says 4.5% is to be maintained, but Indian regulator says no, you have to maintain at 5.5%. But all the ratios are all same, right? For 1.5% for AT1, and tier 2 is to be maintained at 2%, right? So the minimum requirement related to the capital adequacy ratio in general for international banks, it is 8%, but for Indian banks it is 9%, because there was 1% increase in case of the CET1 capital. Is that clear? Why I am telling you these things? Because you may be facing the cases where it is said that an international bank is maintaining the Basel III guidelines or maintaining the capital adequacy ratio. In that scenario, you are to think it from that particular point, that the international bank, which is not in India, right, definitely they will be following 8% of the minimum capital adequacy ratio, not the 9%. But if it is not mentioned at what bank, then we will simply be thinking it's a bank in India, right? For the numerical point of view, for the case study point of view, I'm telling you. While we will be solving the questions, I'll be telling you in detail also, right? For CCB, the same percentage, 2.5% is to be maintained, and the 2.5% is to be maintained in the form of the CET1 component. So let me tell you that these are the different capitals, and different capitals belong to the different capitals are having the different components, right? Like CET1 would be having the different components. Additional tier 1 would be having the different components. You'll be learning these all very shortly. Right after this, the next topic is related to the components of these capitals. So then you'll be understanding. But right now, just understand this point, that the CCB is also maintained from the same components from which the CET1 is made out of, right? So CET1, extra CET1 is to be maintained 2.5%. So minimum CET1 would be equal to what? In case of India, it will be 5.5% plus 2.5%, that is 8%. Is that clear? And the minimum capital which is to be maintained, that is a minimum capital like total CAR plus CCB. For India, it is to be maintained at 9% plus 2.5%, that is 11.5%. For other banks, it is to be maintained at 8% plus 2.5%, that is 10.5%. Is that clear? Are you clear with this thing? So that is the minimum capital requirement. So this particular chart is very much important. If you have understood the point so far, and if you have been liking the video, kindly please do press the like button, give this video a like, and do not forget to subscribe to the channel if you have not subscribed so far, and press the bell notification icon too, so that you get updated whenever we upload the new videos, right? Now let's move further. So the CET1 ratio would be equal to what? Like I told you simply that the capital adequacy ratio, CAR, would be equal to what? Total capital, that is tier 1 capital plus tier 2 capital divided by risk weight assets for different category of the assets, like for the credit risk plus market risk plus operational risk. This is the capital adequacy ratio. And if we are to calculate the tier 1 ratio, if we are just to calculate the tier 1 ratio, then what would be it? Tier 1 ratio would be equal to tier 1 capital, that is tier 1 capital. Now the different components of the tier 1 are equal to CET1 plus AT1 divided by risk weight assets, total risk weight assets, again for credit risk, market risk and operational risk. Is that clear? Now what if I am to calculate the CET1 ratio? CET1 ratio, that would be equal to what? That would be equal to CET1 capital divided by the total risk weight assets for all the three risks: credit risk, market risk plus operational risk. Now this only thing is mentioned over here. So CET1 capital ratio would be equal to CET1 capital divided by the total risk weight assets multiplied by 100, right? Same goes for the tier 1 capital, same goes for the CAR. The another name for the CAR is CRAR. The CAR is capital adequacy ratio, CRAR is capital risk weight asset ratio. Capital risk weight asset ratio. Right? Now, let's have a look at the components of the CET1 capital. Very much important. This topic is very much important because this can get you 5 to 7 marks very easily. 5 to 7 marks very easily, because one case study you'll be definitely finding in the exam related to the components of the tier 1, tier 2 capital. Definitely, for sure, it will be there. In any form, it can be there. So in case of CET1, I can simply be telling you there are total 10 components. There are 10 components related to it, and you should be cramming it if you cannot memorize it, right? Otherwise, it is very much easier to memorize it, but you should be cramming it if you are not able to memorize it. Like, first of all, it's related to paid up equity capital. I already told you about the paid up capital. Like, let's say case the shares are issued. When the company is issuing the shares, like you subscribe the shares, and when the shares are allotted, you pay the money related to shares to the company. Let's say the case that the company share is having the face value of rupees 100. The face value of share is rupees 100, but it is market. It is in the market. It is listed at rupees 153, right? The company is having the face value of the share equal to rupees 100, but in the market it is floating at rupees 153. It means the rupees 100 is basically the paid up value. It is a paid up value of the share, and 53 would be going into the account of the share premium of the general shares. Now there are different types of shares. We are having the preference shares, we are having the general equity shares. In the case of CET1, we are talking about the general equity shares. We are talking about the general equity shares, right? So paid up equity capital would be the component related to the face value. It will be simply be given to you, right? That the paid up equity capital. But make sure we are just talking about the paid up equity capital. If it is mentioned like the authorized capital is not the component of the CET1, because authorized capital is the maximum amount of the capital that any company or banking company may be raising in the market, right? That's another point. So you should be understanding the difference between the authorized capital and the paid up capital. Paid up capital showcases the actual amount which has been received and paid by the company, and which has been paid by the shareholder, right? So that is the first component of the CET1. Further, the statutory reserves. Any of the statutory reserves, if it is there, so that will be the component of the CET1. Any disclosed free reserve. Let's say case you have made a reserve, it's a free reserve available for any of the purposes. Now in that scenario, it's also the component of CET1. Capital reserves. Let's say the case you have sold the goods, you have sold the capital assets, and you received the money from it, right? So that will be forming the capital reserve. So that will also be a component of the CET1. Other than that, the stock surplus. I told you about the share premium, na? That will also be a component of the CET1. So paid up equity capital and the share premium, both are the component related to CET1. Here I'm talking about the general share, normal share we can say. General share I'm talking about. I'm not talking about the preference shares here. Those will be discussing in case of the AT1 and the tier 2 capital, right? That's why I'm differentiating between these two. Further, whatsoever the balance in the profit loss account was there in the end of the previous financial year, in the end of the previous financial year, that will also be part of the CET1. Current year profits can also be the component of the CET1, but there is a condition that quarter to quarter basis, the incremental NPA should not be deviating more than 25% for any of the quarters. Then it can be the part. It should not be the case that previously your NPAs were 100 crore and from one quarter to another quarter it switched to, let's say, more than 25%. Let's say it was 126 crore in the next quarter. Then the current year profits cannot be a part of the CET1 capital, but otherwise, if it is in limit and lesser than 25%, that quarter to quarter basis, if the incremental NP growth is not more than 25%, then even the current year profits can be a part of what? It can be a part of the CET1 capital. Is that clear? Further, revaluation reserves, very much important. Previously, it was said to be a component of the tier 2 capital, but now it's a component of the CET1 capital. Now the revaluation reserves, let's say previously your asset was worth amounting rupees 2 crore in the year 2002. But now when you revalued it, it is somewhat around 20 crore. Now there is 18 crore of the value increment in that, right? And now you can be considering this 18 crore value as your CET1 component, but at 55% discount. So we are to discount it by 55%. It means 18 crores minus 55%. So it is 18 crore minus 55%. That is 8.1 crore value can be considered under the CET1 component. Is that clear? I'm just giving an example related to it. And other than that, the ninth component is what? Let's say case you are having the foreign currency with you, right? In your books, you are having the foreign currency. And whenever we do prepare the balance sheet, we do translate the foreign currency amounts to the Indian currency. And let's say case there was an appreciation when you translated the point. So that particular appreciated amount goes to the foreign currency translation reserves. So that particular amount can also be considered as per the CET1 component. That can be considered, but at 25% discount it will be considered as the CET1 component. And the last component, it is related to the DTA, that if you have any deferred tax asset, you have paid the amount or you are basically eligible to get some amount from the income tax department of the or authority, right? In that scenario, that can also be considered as a component of the CET1 capital. So there are total 10 components which are there in case of the CET1 components, right? CCB is also made out of these 10 components, right? First component is paid up equity capital, statutory reserves, any disclosed free reserves, capital reserves, which are there from sale of the capital assets, stock surplus, if any, balance of the profit and loss account from the previous financial year, current year profit loss account can also be reckoned on quarterly basis, but the condition is that quarter to quarter basis NPA should not be deviating more than 25%, then it can be considered. For the revaluation reserves at 55% discount, foreign currency translation reserves at 25% discount, and deferred tax asset can also be component of the CET1 capital. Is that clear so far? Kindly confirm the same. We will be solving a case study based upon it, and you will be all clear with the points. You'll be all clear with the points. Now, let's move further. These are all the 10 points that we just discussed. Paid up equity capital, stock surplus, retained earnings and profits, statutory and disclosed free reserves, capital reserves, revaluation reserves at 55% discount, foreign currency translation reserves, and deferred tax assets. But only up to 10% of the bank's total CET1 capital, these can be considered if we are talking about the deferred tax assets. Okay, so these are the specially treated inclusions. Why specially treated inclusions? Because in this particular scenario there are limits, like for the revaluation reserves, these are limited to 55%, sorry, discounted by 55%. For foreign currency translation reserves, these are to be discounted at 25%. And for the deferred tax assets, these can be up to 10% of the total CET1 capital, right? So that's the case. And after that, it's related to components of the additional tier 1 capital. Now, the additional tier 1 capital can be maximum of 1.5% of the total risk-weighted assets. Let's say the case the total risk-weighted assets, let's just assume, let's say case these are 47,000 crores. These are 47,000 crores. Now, what will be the maximum amount of additional tier 1 capital? It is 1.5% of the same. So if we are having 47,000 crores multiplied by 1.5%, so it will be 705 only. Maximum amount that can go toward the additional tier 1 capital in this scenario, it will be 7.5 crores, right? 705 crores, not more than that. If you are having any of the surplus amount of the PNCPS or the share premium, then it will be counted toward the tier 2 capital. So any of the amount which is exceeding, right, that will be counted toward the tier 2 capital and cannot be the component of the AT1. So AT1 can be maximum 1.5% of the total risk-weighted assets, right? So it is just having the three components. One, it is P and CPS. I told you we are having the different type of shares, like we are having the normal shares, if we talk about, right, general equity shares, we can say, and the other type, it is a preference shares. Preference shares are those shares where you get some preference. Now these are preference shares are of different types. We are having the redeemable preference shares. We are having the cumulative preference shares, or non-redeemable preference shares, right? Or non-cumulative preference shares. So here is a category specifically which accounts for the AT1 capital. That is PNCPS. That is PNCPS. That is perpetual cumulative, non-cumulative preference shares, right? So if we are having the PNCPS, perpetual non-cumulative preference shares, those will be accounting toward the AT1 capital. Those will be accounting toward the AT1 capital. Is that clear? And also the stock surplus related to it, that is a share premium related to PNCPS, that will be the component of AT1 capital. That will be the component of the AT1 capital, right? And other than that, the debt capital instruments, DCIs or perpetual debt instruments, which are belonging to the AT1 category, right? These are the three components. Okay, so amounts of PNCPS along with the perpetual debt instruments is restricted to 1.5% of the total risk-weighted assets, and beyond 1.5% they will be included in the tier 2 capital. So beyond 1.5%, if there is any amount related to capital, that will be accounted toward the tier 2 capital and not the AT1, right? Further, let's have a look at the components of the tier 2. First of all, let's have a look at the components of tier 2, then we'll be coming back to this particular picture. So components of the tier 2 capital. Components of the tier 2 capital. So first of all, it's related to general provisions and loss reserves. Very much important. General provisions and loss reserves, if there are any, they are restricted to 1.25% of the risk-weighted assets. So if you're having 47,000 of the total risk-weighted assets, 47,000 of the total risk-weighted assets, so in that scenario, it will be 1.25% of it. So it will be 587.5 only. 587.5 only. So if you are having general provisions and loss reserves amounting 700 crores, so out of it only 587.5 crore will be accounted for the general, for the tier 2 capital, and not more than that, because the restriction is 1.25% of the total risk-weighted assets. Other than that, the debt capital instruments can be a component of it, but there is a restriction related to it. We'll be learning all about it. And for the tier 2 capital, the class of the preference shares related to perpetual cumulative preference shares, RCPS, that is redeemable cumulative preference shares, RCPS, and RNCPS, that is redeemable non-cumulative preference shares, RNCPS. So the capital and the share premium related to these three categories, PCPS, RNCPS, RCPS, that will go to the tier 2 capital. So first of all, general provision and loss reserves. Second one, debt capital instruments. Third one, the stock premium and the capital related to PCPS, RCPS, RNCPS, right? And further, PDI, that is perpetual debt instruments. These are the hybrid instruments, right? These are the hybrid instrument that will also be accountable for the tier 2 capital. That will also be accountable for the tier 2 capital, and these can be issued in forex up to 25% of the total amount issued. These PDIs can also be issued in forex, foreign exchange, but maximum limited up to 25% of the total amount issued. And the minimum maturity which can be there in case of the PDI should be of 10 years without any put option, and call option can be used by the bank after the 5 years of the period. Now what is this put option and call option? It might be confusing, right? Let me explain this to you. So just first of all, think of the thing ki these can be issued in forex, PDS can be issued in forex, and the maximum forex amount which can be issued, that is 25% of the total issued amount. So if you have issued the PDS amounting 10,000 crore, out of this 10,000 crore, 25%, that is 2,500 crores of the PDS can be issued in foreign currencies. First thing. Second thing, the minimum maturity of these PDIs should be of 10 years, and that should be without any put option. Without any put option. Now, put option gives the investors a right. Now, debt instrument is something what that if you issue a debt instrument, the investor is going to invest in that particular debt over there, right? So if you're investing in debt instrument, you are a investor, right? So put option is a right related to the investor. So put option gives the investor a right to sell, right? But not an obligation. So if that would be favorable for the investor so as to sell this particular instrument, then in that particular scenario, the investor can sell this particular instrument, right? So that would not be available. That would not be available in the 10 years of the tenure, first of all. The second thing, the call option, that is bank's right. The call option is bank right, and the put option is investor's right. Put option is right related to selling, and the call option gives you right related to buying. So if the bank want to buy back the debt instrument, that can be done after the 5 years of the period, not before that. Not before that, right? And if the residual maturity of the PDI is less than 5 years, let's say case the residual maturity of the PDI is amounting 1000 crores, right? And it is having the maturity of 4.5 years, 4.5 years, then you cannot be counting this 1000 crore value as it is as per the tier 2 capital. You need to discount this value, and how much discount will be applicable, this is as per this table. So this is very much easy to basically write. You can easily be managing to remember this table, memorize this table. How come? First of all, do write 1, 2, 3, 4 and 5. Further after that, write 100 and opposite with 20 gap, 80, 60, 40, 20. Table is prepared. Now, if the residual maturity is less than 1 year, residual maturity means the remaining maturity of the instrument. If it is less than 1 year, then 100% discount. If less than 2 year but 1 year or greater than it, then 80% discount. If greater than 2 years but up to 3 years, then 60%. If it is lesser than 4 years but up to 3 years, then 40%. If less than 5 years but up to 4 years, then 20%. Now in this case, we are saying that 4.5 years of the age means it will be belonging to this category. Then 20% is to be discounted, means 1000 crore minus 20%. So it will be considered 800 crores only. 800 crore value will be considered only, right? So those are the components related to the tier 2 capital, right? So the tier 2 capital, first of all, it could be the General provision or the loss reserves limited to 1.25% of the total risk-weighted assets. Debt capital instruments can be there. Other than that, the preference shares, that's the PCPS, perpetual cumulative preference shares, redeemable non-cumulative preference shares, RNCPS or RCPS, right? These are the components related to tier 2. Other than that, the PDIs can also be the component related to it, but the minimum maturity should be of 10 years without any put option, and the call option may be available by the bank, but after 5 years, right? And further, if the residual maturity in case of the PDI is less than 5 years, then the discounted value is to be taken. And how discount is to be applied, that I already told you, right? Now, let us solve a question based upon it, or first of all, we'll be going for the theory. Kindly confirm. We should be going for the theory first of all, or we should be solving a case study. Do write yes for the case study and no for the theoretical component first of all. And in between, if you want to get the PDF of this file, just WhatsApp me writing the CAIIB updates. You need to mention CAIIB updates and WhatsApp me to the number 83609 44207. Or simply you can be downloading the application iibf.info/app. Okay, so we will be going for the theory first of all, and after that particular we will be going for the case study. No worries. So as I told you about the tier 1 capital, it is said to be the core capital, most permanent capital, most liquid capital, right? Tier 2 capital is a supplementary capital. Now here is an important point related to it. The first point, it says that the tier 2 capital at no point, it should not be more than 50% of the total capital. If your total capital is 1000 crore, then your tier 2 capital cannot be more than 500 crore. That's the first restriction. And your tier 2 capital can never be 100% of the, cannot be 100% more than the tier 1 capital. So if your tier 1 capital is 700 crore, your tier 2 capital cannot be more than 700 crore, right? So these are the two important restrictions related to the tier 2 capital on whole, right? Is that clear to you? Kindly confirm these points at the earliest if you're clear with such points. Kindly do confirm at the earliest. Are you clear with these points? Okay. After that, we are moving to risk weight percentage. Now, this is as per the standardized approach. This is as per the standardized approach. I already told you about it. This is related to risk weight percentage. So first of all, it's related to if you are having any cash balances with the Reserve Bank of India. Cash balances with the Reserve Bank of India. In that scenario, risk-weighted asset percentage is 0%. It is 0%. And if you're having the balances with the other banks, then it is 20%. And loans which are guaranteed by central government, then 0%. If guaranteed by state government, then 20%, right? If you're giving secured loan to staff, let's say case, if you're giving the secured loan to staff and those are secured by the mortgage or superannuation benefits, then the risk weightage percentage will be 20%, right? And if loans up to 1 lakh rupees against the gold or silver, then it is 50%. And if you're giving any other staff loan, then it is 75%. If central government advance is there, let's say direct advance is there or guaranteed advance is there, then 0% as I told you. If state government guaranteed advance is there, then 20%. If loan to PSU is there, then it is 100%. And let's say guys, if corporate loans are given, and it is unrated, then in that scenario it will be 100% again, right? And further, other than that, if we are having the loan which are guaranteed by the ECGC, then very important, it is 20%. If there is any small scale industry advances to CGT MSC based upon the CGT MSC guarantee or DICGC guarantee, then 0%. Very important, then 0%. advances against a term deposit or LIC policy or NSE where adequate margin is there. This is the condition. Adequate margin is there, then 0% again. If there is any consumer credit, credit card, capital market exposure, then it is 125%. Even in the case of the personal loans, let me write over here. Even in the case of the personal loans, it is 125%. And when we are talking about the venture capital funds, it is 150%. And if there is any regulatory retail loan, let's say education loan or something, then it is what? Then it is 75%, right? And further, if there is any microfinance loan, this is a new category which is added. If there is any microfinance loan, in that scenario also it is 100%. It is 100%. Is that clear? Now, what will be the risk weighted asset percentage for the housing loan? Anyone? I've told you these all. Just tell me one thing. Risk weighted asset percentage. Now, existing percentage, if we look at, particularly, it's based upon the LTV ratio, loan to value ratio, first of all. It is based upon the LTV ratio. Now, if the LTV is lesser than or equal to 80%, lesser than or equal to 80%, then the risk weightage percentage for the housing loan is 35%, right? And if LTV, it is greater than 80% and lesser than or equal to 90%, then the risk weighted asset percentage will be 50%. Then it will be 50%. Okay. There is a framework related to it that is going to be there, that can be there in 2027, but right now it is not finalized. We won't be talking about it. So you need to memorize these. You need to memorize these percentages. Is that clear so far? So do like the video and further share the video at the earliest, and simply just do write CAIB. If you want to get the complete pack, complete course related to all the 5 papers of the CAIB, just simply do WhatsApp CAIB and WhatsApp it to the number 83609 I'll be sharing the complete details to you, like, and you'll be getting the full course videos, chapter wise previous year questions, mock test, mega test, PDF notes, each and everything. The case study videos will also be covered, right? So that will be all. Thank you so much and see you again in the next video.